This is level 2 of the CFA program, topic 1, ethical and professional standards, and the reading on guidance for standards 1 through 7. This recording will focus on standard 2, integrity of capital markets. Let me begin by just reminding you about capital markets. Remember from your undergraduate days, you learned about the importance of primary markets and secondary markets. When I think of capital markets, I, of course, immediately think of the floor of the New York Stock Exchange and the floor of other organized exchanges and electronic markets and bond markets and derivative markets. And I think about these capital markets as being the pulse or the heartbeat of the free enterprise system that has been so successful in performing at least two functions, one of which is liquidity, the other one is allocation of resources. But note that the CFA Institute is really emphasizes the integrity of these capital markets. This has two components, right? Material non-public information and market manipulation. So let's go ahead and look at the learning objectives here. They're the same for all 7. And I think that the first handful demonstrate and recommend. Those are pretty standard, but I think the emphasis ought to be on that fourth one down there. You'll probably be given a scenario on the exam and then be asked to identify whether a violation occurred or did not occur. So let's go ahead and start with standard 2A, material non-public information. Members and candidates who possess material non-public information. And by the way, remember that as good financial analysts and as good financial risk managers, we're going to possess material non-public information, just as part of our regular responsibilities. And so possession, of course, is not a violation. The question then becomes, what do we do with that information? And notice what we have written there in bold: must not act or cause others to act on the information. Let me tell you a quick story. Years and years ago, the school where I was teaching delivered the MBA program to a super large corporation in the area. And I taught my corporate finance class there every Wednesday night. And between Wednesday nights, this was over the summertime, between Wednesday nights, this large corporation made a bid for a smaller corporation. And that smaller corporation's stock price doubled from one Wednesday's class to the next Wednesday's class. And so the next Wednesday I got there to class and, we kind of joked around. I said, oh, hey, by the way, thanks for filling me in on this private information from last week. And they, of course, said, well, we didn't know anything about it. And then we talked about, all right, if we did know about it, what would you do? And we talked about stocks and we talked about options and maybe other derivatives. But of course, if we were to act or cause others to act on that information, that would be a clear violation. So I want to emphasize that part of that story, integrity, right? Those individuals at this large corporation, they said they didn't have this information. I, of course, believed them. But if they did, they would not have been permitted to relay that information to me. Now, remember, this has nothing to do with CFA stuff. This is illegal, right? Passing on private information. But of course, as a good financial analyst, I could have received that information and I probably would have gone like this. If they would have started talking about it, I'm sure I would have covered my ears just to be safe. All right, so what constitutes material information? All right, I bet you guys know this back from level 1. This is pretty standard stuff. If its disclosure would affect a security's price or any reasonable investor. And remember the recording on professionalism that I'm hoping that you guys just watched. There's that word again, reasonable. A reasonable investor would want this information before taking investment action. Some examples: earnings and bankruptcies. Of course, there's mergers and acquisitions from my example from just a few moments ago. Now, as I'm recording this video, I can't help but want to share the GameStop. Here we are in early 2021. GameStop, did we buy this at 14? Did we sell it, when it neared $500? Boy, material information. Who knows what's going on there? I have my own kind of personal thoughts about this process. Maybe we'll find out because Congress is, looking for some type of an inquiry. Maybe we'll never know what happened, but it's fun to watch. I hope you guys are enjoying watching the price go way up and way down and then way back up again. All right, so what is non-public information, right? Has not been released to the public. And look at the purple arrow point that we have written at the bottom. This is what I said just a few brief moments ago. Members and candidates are permitted to receive non-public information, but are not permitted to act on it unless it becomes public knowledge. And we'll see in a slide or two that if you receive this non-public information, one best practice is to try to convince the providers of that information to, hey, let's put out a press release so everybody has it. How about this concept of a mosaic theory? I was fascinated by this when I first went through the program 15 years or so ago, because I always thought, look, we're being trained to think a certain way in all of level 1, level 2, and level 3 materials. What if we really have a skill set where we can combine all of this information and then make a recommendation that somehow might appear to challenge the integrity of capital markets? And that's what this mosaic theory addresses. So look at the first arrow point. Analysts are allowed to combine their analysis of public information, right? So we're scouring the Wall Street Journal, we're scouring Bloomberg, we're scouring any other resource that we have, and we're collecting all this information and then processing it. Maybe we have some quantitative model, maybe we have an interest rate model, maybe we have a credit default swap model. So we process all of this information. And if we use some non-material, non-public information, then this is not a violation. So look at the second arrow point. An analyst's use of a combination of public and non-material, non-public information may lead to conclusions, right? We're super smart, and this happens all the time. If we're super smart and people want to follow us, then of course, that might lead to something that would be construed as material, but it, of course, is not a violation. But remember what I said in that professionalism recording, that as long as you use somebody else's information, this was on the plagiarism issue, just put in there, say, yeah, I use this person over here. Same kind of a concept here. Look, notice the note down at the bottom. Analysts must keep records of their research activity. That makes sense. All right, social media. We talked a little bit about this in the previous recording, but this is probably even more important here. All right, so what do we need to do if we're on social media? We get some information from social media source, right? So we need to verify that the information is publicly available. So we can go to, company websites, we can go to the SEC filings, we can go to the press release, we can go to web pages where we have tons and tons of financial information. The second component of this is that we need to make certain that we are not targeting a particular client base with some of our information that may or may not be private, right? If we have two social media accounts, we have one for our ultra high net worth clients, and then we have one for our regular old clients. We want to make sure that information gets disseminated to both of those people, both of those groups of people at the same time. Look at the note. No difference in the information disseminated through traditional media channels or social media channels. And then what does that last diamond point say? Complete all regulatory filings. So this goes back to what I said in the previous slide about keeping records. It goes back to the previous recording where you need to make sure you cite all of your resources. Of course, you can use industry experts. It's recommended. If you don't know something, pick up the phone and call an expert, and you can compensate them. But you can't compensate them for confidential or material information. Here's what I was saying a little bit earlier, use of investment research reports. So renowned and superstar analysts have the potential to move markets, of course, right? If we're really, really good at what we do, we want people to demand our reports. And if those reports are valuable, and if they're consistently valuable and sustainable, all those good words, then our mosaic theory, our opinions are going to be important, and maybe they'll move prices. Yeah. Notice the conclusion at the bottom. This does not violate this standard. All right, recommended procedures here, right? So encourage the issuing company to make any material information public. I said that a few minutes ago, right? Here we go back to our compliance department. Make sure we have some compliance procedures regarding material non-public information, whether or not we're in possession of it or we see somebody else who's in possession of it, right? Disclosures and then firewalls and then physical separation of departments. You know, I thought there's a little bit of irony in that last diamond point. This, of course, was written in the pre-COVID days. Now we seem to have physical separation of just everybody right here in early 2021. Maybe that'll change, but we'll see. All right, here's a good example. We have a level 2 candidate, conversation with a personal trainer about a company. The trainer, an avid investor, you know, there's a good part of the question stem, believes Albright, this company, will be acquired by a bigger telecommunications company. All right, so what McVeigh then does is aggressively purchases for his own personal account. Is this a violation? Probably not. How about market manipulations? Boy, not engage in practices that distort prices or artificially inflate trading volume with the intent to mislead market participants. All right, so what is market manipulation? Practices that distort, you know, either the prices or the trading volume with the intent to deceive. And so, of course, this slashes that word integrity. If we're trying to deceive or distort or trick or fake, you know, I always like to give sports analogies. And, you know, one of the great things about team sports is that the winning team typically fakes out the other team. No matter what it is, whatever sport it is, you get faked out and you lose. And of course, that's one thing in the sports world. But here to maintain the integrity of capital markets, we need to avoid those kinds of things. So information-based manipulation, transaction-based manipulation. Let me go back to the GameStop example, and I'll just put a big question mark here. Is there manipulation? You know, my own thought is probably not. I think it's probably just groups of people hoping to take advantage of expected behavior of other groups of people. How's that for my summary of GameStop? All right, so information-based manipulation, false or misleading information, you know, pump and dump. Let me go back to the original example. I wonder if you guys ever heard of this, the company RCA. You know, they were like a record company and a radio station, you know, and this is in the teens and the 20s. And when I say teens and 20s, I mean 1900. So this is 100 years ago. This was a big classic pump and dump that, boy, if I remember the numbers correctly, RCA, before the stock market crash of 1929, was trading at some astronomical number like $500 or $600. And then, of course, it couldn't continue, and the price fell. But there were a handful of investors who made tons and tons of money in the mid-1929, I think. How about transaction-based manipulation? So this is activity that affects the price of the security with the intent of distorting, you know, either, and this is important, trading volumes and market trades. And wash trades is a good example. You know, you have a trade and then you have another trade. Maybe it's tax motivated, but maybe it's, you know, similar to kind of a pump and dump, but you trade and you get everybody thinking that the trading is going on for regular fundamental reasons. Maybe it's not. So here, in parentheses, let me just say, okay, let's see about GameStop. We'll see about all that stuff as it washes out, so to speak. Look at the note. Legitimate trading strategy, of course, are not a violation of this standard. Big key is intent. How about another example? We post false rumors about an acquisition of a competing firm. So, boy, if you read that in a question stem, false rumors, you ought to scratch your head just like I did, you know. So, but then notice how the question then brings it back down to, let's see if it's reasonable, right? So the attempt to pump up this company's stock price is unsuccessful and it stays, you know, within its trading range. You know, is this a violation? Of course it's a violation. Just because this individual didn't make tons and tons of money doesn't mean it's not a violation. The intent, right? So you get the idea of the intent. And so there's the answer in that last arrow point, intent of his actions. And that takes us through this particular standard.